Nokia stock is currently trading at $13.30 per share on the New York Stock Exchange as of the market close on May 1st, 2026. This represents a solid intraday gain of 3.02% during the last session, with the price moving up by 39 cents. While the broader market has been eyeing local volatility in various regions, Nokia has managed to push toward the top end of its 52-week range, which sits at $13.89. Most people looking at these numbers assume we are just seeing a standard recovery in the telecommunications sector, but the reality is much more aggressive. The expectation is that Nokia is a slow-moving legacy hardware company waiting for the next cycle of cell tower upgrades. The reality, however, is that Nokia has quietly repositioned itself as an essential backbone for the infrastructure that supports large-scale artificial intelligence. While the average retail investor on a Robinhood app might still think of them in terms of mobile handsets or basic 5G antennas, the institutional activity suggests a massive pivot into optical networking and data center interconnects. This is the part of the story most are missing. If you are looking for investment help or exploring investing sites to find the next big runner, you have to look past the brand name and into the order books. The common belief among those practicing self-investing is that Nokia is constantly playing second fiddle to Ericsson or losing out to Samsung in the public 5G space. While it is true that Ericsson recently secured a larger share of a high-profile UK contract, Nokia has effectively decided to stop chasing low-margin public network deals that do not serve their long-term bottom line. Instead, they are moving toward the high-margin world of AI-native mobile networks. This strategy was solidified with a massive $1 billion investment from NVIDIA in late 2025. This was not just a financial boost, it was a technical integration that allows NVIDIA-powered AI workloads to run directly on the network edge. When you see NVIDIA stock reaching historic valuations, you have to ask what infrastructure is actually carrying that data. For a lot of the global hyperscalers, the answer is Nokia's optical networks. In fact, 9 out of 10 of the top global hyperscalers are now using Nokia for their optical infrastructure. This is a level of market dominance that the general public hasn't priced in yet. Many traders using a Fidelity mobile app or an interactive brokers platform are just now starting to see the volume spikes that confirm this institutional shift. Nokia's recent movement has been characterized by a breakout from its decade-long range. For years, the stock was stuck between $3 and $6, frustrating long-term holders. But the recent Q1 2026 report showed a 49% growth in their AI and cloud segment, which now accounts for a significant portion of their total group sales. This is where the tension between expectation and reality becomes profitable for the disciplined investor. The market expected a 16% growth rate in the AI and cloud addressable market, but the updated reality is a projected 27% growth rate through 2028. This acceleration is forcing lead times to extend across the entire supply chain. If you are active in online investing, you know that when demand outstrips supply to this degree, the companies with the manufacturing capacity win. Nokia is currently ramping up a new indium phosphide facility in San Jose to meet this exact demand. This isn't just about cell phones anymore. It is about the physical cables and processors that keep the internet from breaking under the weight of generative AI models. To give you an idea of the scale we are talking about, Nokia recently booked over 1 billion euros in orders specifically from AI and cloud customers in a single quarter. This is the kind of detail that makes the difference between a casual trade and a serious position. While you might be using an individual brokerage account to buy a few shares, the big players are looking at the book-to-bill ratio, which is currently well above 1. This indicates that Nokia is receiving orders faster than it can fulfill them, a classic sign of a company in a high-growth phase. Despite this, the stock still trades at a forward price-to-earnings ratio of around 12.5, which is a massive discount compared to other high-growth peers in the networking space. This valuation gap is exactly what smart investors look for. Comment below how many shares of Nokia stock you currently hold, or if you think they can actually maintain this lead over Ericsson in the AI infrastructure race. Understanding what this company does today requires forgetting almost everything you knew about them 10 years ago. Nokia's business model is now divided into 3 core pillars: network infrastructure, cloud and network services, and Nokia Technologies. The infrastructure side is the current powerhouse, driven by the acquisition of Infinera in 2025. This move allowed them to scale their fiber and optical engine capabilities, which are now essential for data transfers between massive data centers. Then there is the Nokia Technology segment, which is a high-margin licensing business. They hold a vast portfolio of patents that virtually every smartphone and automotive manufacturer in the world has to pay for. This provides a steady stream of recurring revenue that isn't tied to how many pieces of hardware they sell in a given month. It is the ultimate safety net that allows them to take big swings in the 6G and AI RAN space. As we look at the future outlook, the real catalyst is 6G. While most of the world is still trying to get 5G to work perfectly, Nokia is already leading the global testbeds for 6G sensing. This is a fundamental change in how we think about connectivity. In the Nokia vision Nokia is building, the network itself acts as a radar. It can detect movement, objects, and people without the need for cameras.
Think about what that does for autonomous logistics, healthcare monitoring, and smart city management. The reality is that Nokia is moving from being a pipe for data to being the intelligence within the pipe. This shift is attracting attention from those looking for online investment opportunities that offer more than just a bet on consumer trends. The risks, of course, remain. Geopolitical tensions and trade policies can impact a global entity that earns in dollars and rupees but reports in euros. However, with a net cash position of approximately 5 billion euros, Nokia has the balance sheet to weather any short-term storms. Institutional activity in the last few months have shown a marked increase in positions from major wealth management firms. When you look at the holdings in various Fidelity ETFs or Fidelity mutual funds, you'll see Nokia's weight starting to creep up as analysts realize the AI supercycle isn't just about software. It is a physical transformation of the world's digital nervous system. If you are using a SoFi active investing account or Interactive Brokers trading tools, you can see the institutional flow for yourself. The volume isn't coming from retail hype. It's coming from professional desks that understand the value of an investment-grade balance sheet paired with a 20% growth rate in optical networks. The recent sale of their fixed wireless access business to Inseego also shows a management team that is willing to trim the fat and focus strictly on the highest margin opportunities. They are no longer trying to be everything to everyone. They are trying to be the most important company for the most important tech trend of the decade. The takeaway here is that the market is still treating Nokia like a legacy telco, but the financial reality is reflecting an AI infrastructure leader. This disconnect is where the opportunity lives. Expectations are rooted in the past, while the reality is being built in the Finland campus and the Silicon Valley manufacturing plants. Whether you are using Schwab Intelligent Portfolios for a hands-off approach or managing a portfolio through the Robinhood trading platform, Nokia represents a unique intersection of value and growth. It has the stability of a company that has been around for over a century, but the upside potential of a tech firm that just discovered a brand new revenue stream. The contrast between what people believe about Nokia and what Nokia is actually doing is at an all-time high. In summary, the current price movement suggests we are seeing the beginning of a re-rating. As the market begins to price in the 27% compound annual growth rate of the AI and cloud segment, that $13.30 price tag may soon look like a relic of the past. We have seen a solid start to 2026 with expanding margins and a massive influx of orders that have pushed the company to increase its growth assumptions. The partnership with NVIDIA and the integration of Infinera have provided the specialized capabilities needed to dominate the edge AI sec. For anyone involved in self-investing or looking for investment help, the narrative is clear. The legacy hardware story is over, and the intelligent infrastructure story has begun. This is a business that has successfully navigated the most difficult decade in its history to emerge as a leaner, more focused, and highly profitable engine of the digital economy. Keep a close eye on the upcoming quarterly reports to see if they can maintain this momentum, and if the book-to-bill ratio continues to signal a massive backlog of high-margin work. The authority of Nokia in this new space is no longer a question of if, but a matter of how fast the rest of the market catches up to the reality. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.